Ever wonder if your deposits just sit in a vault? They don't. And that's why banks can pay bills, lend money, and stay safe. Here's what you need to know. Most people picture their cash sitting untouched, but a bank doesn't store 100% of deposits as bills in a back room. The moment you deposit money, it can move inside the bank's system, even though you still see the same balance. Your withdrawals don't require your exact dollars, just enough available liquidity to pay you. And banks absolutely lend using deposits as a core funding source. Insurance helps, but it doesn't cover every dollar in every situation. A checking or savings balance is basically the bank's debt to you, not a box with your name on it. Banks use deposits to fund loans, then they rely on steady cash flows, paychecks coming in, loan payments coming back, to meet withdrawals. To handle surprises, they keep liquidity buffers like cash and easily sold securities. Holds often happen because payment timing is messy, not because the bank lost your money. And if funding gets tight, banks have backstops to borrow for short-term needs. Banks make most of their core money on the spread, the gap between what they earn on loans and what they pay you on deposits. That spread gets real on everyday balances. On $10,000, even a 2% difference is about $200 a year. Checking tends to pay less because it's instant access and expensive to service with fraud controls and payments. If you lock money longer, like in a CD, banks can pay more because they can plan around it. Fees add profit, and loan defaults shrink it. Deposit insurance is real, but it has strict rules, and knowing them keeps you safe. FDIC coverage is up to $250,000 per depositor, per institution, per ownership category, and joint accounts can effectively reach $500,000 for two owners. But not everything is insured. Stocks, bonds, and mutual funds aren't bank deposits even if you buy them at a bank. Coverage also doesn't stack across different brands under the same institution. Banks also must meet reserve and liquidity requirements, but your move is to verify account ownership and coverage. Once you understand how banks use deposits, you can structure your money to match what it's for. Keep day-to-day spending and checking, but move your emergency fund to a high-yield savings account so idle cash earns more. Set up free ACH transfers so you can move money in 1 to 3 business days without wire fees. Always verify FDIC or NCUA coverage, especially if you open accounts through an app. Avoid out-of-network ATMs to cut surprise fees. And don't confuse insured deposits with investments, because investments can drop in value. FDIC insurance is capped at $250,000 per depositor, per institution, per ownership category, so how your account is titled changes your protection. BankingHub can match you to accounts based on how you actually bank and show the real dollar impact on your balance. Free? Takes about 2 minutes. Links in the description.